so we're going to start talking about insurance today, obviously. And we're going to go through a variety of different types of insurance. First thing, we'll talk about some generic terms. Insurance is just basically a type of contract, so it is a legal agreement between various different parties. First party is the insurer. The insurer is the company that's providing the insurance in exchange for what we call consideration. Remember when we went through contract law and we talked about consideration? Consideration in the insurance contract, one party is providing the payment, the premium. That's the insured. And that insured is providing that in exchange for the insurer covering or compensating you in the event of a loss. And insurance is covering against specific losses. Okay, so life insurance is not going to cover you for a disability if you get disabled. Nor is car insurance going to cover your home if your home gets robbed, okay? So specific insurance policies cover specific types of loss. The policy is the actual contract itself between the insurance company and the person that's being insured or parties that are being insured. The policy holder is the person who buys the insurance policy, and the insured is the person whose life or property is insured. Alex and then John.
So if you're insuring like all these things like life insurance, you have your car insurance, you have your health insurance. Those three things like we total up to like maybe over $1,000. So are there people who like just go without that stuff or without?
Well, yes, you can opt
if
to.
you're young, like right out of college, can you do that? Or?
You can opt to not insure certain things. If you own a car, in most states, you have to have insurance. That's a requirement to have a car. Life insurance is typically optional. You're running the risk of not being insured. Now that we have Obamacare, it's required that everybody has health insurance. So there are different types of insurance that are required. Some types of insurance are not, though. And it can cost way more than $1,000 for all of them. Yes?
Does the insured have to be a policyholder?
The insured and the policyholder do not have to be the same party, okay? So, I can get insurance, for instance, on my husband's life. What you have to have, and we'll talk about that in a minute, is you have to have what we call an insurable interest in order to insure something.
If you get like health insurance or through your work, would they be the policyholder and you're the insured?
No. The policyholder, so if you get insurance through work, the contract is kind of like a triple way contract, if you will, because the policyholder is the parties to the contract are basically going to be you, the insurance company, and your employer. Okay, and the reason that it's three is because typically when you have a health insurance contract and it's through your employer, is your employer's paying for part of it, and typically you're paying for part of the premium. So both parties. But whomever the insured is, which could be you, it could be your family members, so there could be different people that are under that same health insurance policy. Okay?
Do you have to have the consent of the insured to be a policyholder?
Do you have to have consent?
Say, I insured the life of President Obama.
Of who?
Obama.
Okay.
Should I do that?
Okay. So we'll talk about that. That has to do with what we call insurable interest. You have to have something that's called insurable interest in order to get a policy on something. Whatever that something is, whether it's a person or an asset, you have to have what they call insurable interest. And I'll talk about that. Other questions? All right, I'm going to move on. Beneficiary. The beneficiary is the person named in the policy to receive the benefits in the event of a loss. The insurable interest, the thing that we were just talking about. It's the ability to take out an insurance policy on a person or property because you would suffer a loss, okay, or financial burden if whatever that item or person gets hurt or injured, okay? So you have to have that insurable interest. So, like you use the example of Obama. Now, you're not going to suffer any financial burden if President Obama were to be either injured or die. You might be sad, the country might be grieving, whatever.
There could be like an economic.
It could be an economic downturn, but it's not a direct financial implication to you. It's not. They can't really tie it together. Okay, you're not going to suffer direct financial loss as a result of President Obama, something happening to President Obama.
Oh, is that so, they do that so people can't like get life insurance on like random people and then if they pass
And then
away-
kill them, yeah.
Oh yeah, that's
Or
another
something.
question I had. Like, let's say with people, like, they get life insurance on someone and then that person.
And that,
Would the
wait,
police like be investigated?
Logan, take the earbud out. Thank you. What's that?
So like, let's say you insure like your wife or husband's policy and like you get life insurance for them. If they pass away and like it's recently after they're insured, like you insured them, would the police investigate you or like how does that work?
It depends on the situation. It depends on the situation. You could take out a life insurance policy on somebody and then they, get in a car accident. There would be no reason necessarily to assume that you did something. There would have to be. It would depend on the circumstances. But yes, Nevaeh.
Do you get health insurance for the school?
Do we? Yes. Well, I don't personally because I get it through my husband. But yes, if you opt to be on the health insurance policy that the school has, then yes, you
Isn't it,
can.
don't some companies like incentivize like if they give you free gym memberships and stuff and you get like, because it's cheaper for their insurance?
Well, the reason, yes, the long and short of it is yes, some companies do incentivize you to become members of a gym or, maybe take health fitness classes and the like because it's deemed that if you're healthier, you're going to have less, you're going to ultimately cost them less money because you'll go to the doctor less, you'll have maybe less risk of heart disease or chronic illnesses. So they incentivize it so that you are healthier. You make healthier choices. Yes, Kyle.
At vet, like I have to print sometimes the check-ins for people that they checked in like a certain times a month so that they could show their insurance company it lowers their insurance.
Interesting. Didn't know that. That's
And
really
it shows, like,
interesting.
the amount of time that they were there.
Wow.
So like, and I have the whole thing of it. I think like I don't know which company does it, but then they have their insurance level.
Wow. That's cool. I didn't know that. That's really cool. Okay. Go ahead, Adam.
If the company gives like health insurance for an entire family, can they like refuse to hire someone if they have like a large family because it would cost more to insure them?
They cannot discriminate. You can't discriminate in employment to avoid having, the company can't discriminate in employment of somebody because of however many kids they have or whether they're married or not married. No, they can't discriminate.
So they can't like refuse them insurance either.
Nope, they cannot.
It would
Nope.
cost more, right?
Say what?
It would cost them more, the insurance company to insure the person.
Oh, yes, the premiums will be higher. If there's more people involved, there's usually a higher premium. But that being said, they usually have ranges. So, like when you go and you're getting insured, do you have like say, is it going to be just the husband? Is it going to be the husband and wife? Is it the husband and wife and 1 kid, 2 kids, 3 kids? So sometimes after like 3 kids, they might do like a family, more than, 3 or more, and it's a higher premium. Yes. Yes.
No, like at St. Peter's, when my mom took a doctor there, they require like all their like staff members to like, I'm pretty sure my mom's probably on that list. Like my mom has to, they give her membership to that, and then they give, like they have like even on Thanksgiving, like they give like the people food, like our turkey, stuff like that. Like they give them things. Like every year, like anytime like any holidays come around, like they give you something healthy or whatever to like go home and eat or
To give you healthy choices.
Yeah.
That's good. That's a good thing. Okay. So that's insurable interest rider. is an attachment to an insurance policy that somehow modifies the terms of that insurance policy. So for instance, you could have different riders on various policies. Like, so for instance, a rider on your car insurance policy. You might have a rider that you would add on to have insurance coverage when you travel. So like for instance, if you rent a car when you're traveling, the insurance will cover you when you're renting a car, when you're traveling. So that's important for you to know, so that when you did go and you travel, if you go to rent a car, a lot of times, well, all the time when you go to rent a car, they basically ask you, do you want the insurance? Because if you don't have that insurance, that rider on your own car insurance that says it covers you when you rent a car, then when you go rent the car, they want to make sure you have insurance when you rent the car. So you should know that, because otherwise you're going to be paying twice. Okay? So you could also get riders on your policy. So for instance, on your homeowner's policy, you might get, if your parents or your mother or somebody has some valuable jewelry or the like, they might get a policy that's a rider on their homeowner's policy to provide additional insurance for those types of things. Okay? You add it, and it adds extra to your cost as well if you have those. So some additional terms. The premium is the amount of money you pay for your policy. The proceeds are the amount paid by the insurance company for the losses. The face value is the amount of protection stated in a life insurance policy in particular, and the amount the beneficiary would receive if the insured dies. That's the face value. Versus cash value, it's an amount of money that you can actually borrow against when you buy a life insurance policy. So cash value really only goes along with a certain type of life insurance policy, and we'll talk about that life insurance policy on a later slide. A couple slides down the road here. Okay? So cash value is an amount of money you can borrow against or cash in on certain types of life insurance policies. So 3 broad categories of insurance: life insurance, health and disability insurance, and then property insurance. We'll start out talking about life insurance. With insurance, really how the insurance company makes money is from their perspective, it's called pooling of risk. Okay? So let's say we have our entire classroom here. Okay? So technically speaking, Ms. Richardson and I are probably, what you would say in this pool, we're the highest risk for health and life insurance, okay? The reason is because we're the oldest. We're older. So like with car insurance, younger is more risky. Well, with life and health insurance, older is more risky, okay? So there's greater chance of us getting ill, there's greater chance of us dying, etc. So what an insurance company does is they look at the pool, all of us, okay? They're going to look at when you've got what we call a group policy, and even in areas, like they look at the statistics in this particular area. They look at the general health, the general well-being, the economic lifestyle that people live, age of people, in numbers of injuries and issues. They look at a whole bunch of data and statistics, and they figure out statistically what the risk level is of the pool, okay? And then that's how they go about determining what the premiums are. So all things being equal, if we were all the same age and all of that kind of stuff, we would all have the same cost for our premiums. But we won't have that same cost because no matter what, Ms. Richardson and I, we're higher risk in terms of health insurance and life insurance. So therefore, our premiums are going to be a little bit higher, okay? What the insurance company does, why they look at the whole pool, is because they're going to figure out statistically what percent of chance they have of loss as it relates to that whole pool of people. And they base their premium costs on that. Because the fact of the matter is, we are not all gonna get sick at the exact same time. We are not all going to get the exact same illnesses. We're all not gonna get treated in the same fashion. We're all not gonna get the same medicines, et cetera, et cetera. So they balance that out, and that's how they work out the statistics so that they're not losing money. What ends up happening, like say, a good example of, I see you guys. Hold your questions for just 1 second. Like what happens, let's say with homeowners policies, in areas, let's say where there's a higher risk of hurricanes and the like, sometimes what happens is they base things on statistics and the like, but then there's what they call a catastrophic loss in a particular area, meaning there's so much loss.
Or something like that.
Yes, right, like Katrina, or, when they had, oh my gosh, what was the hurricane down where it hit New York City and all that? Sandy, yes. So much loss all at the same time. Well, now it affects everybody. So either sometimes they'll stop, an insurance company might stop selling insurance in that particular area because they sustained so much loss in that area that they don't want to go back into that risk pool. They can't, they find it hard to, the premiums would have to be set so high in that area that they can't really, people won't be able to afford it, and so therefore they decide not to be in that area. Okay, so things like that do end up happening. Or they require additional types of coverages or different things like that. Like after Sandy happened in my sister's area, my sister's neighborhood, the end of her street is the Great South Bay. So like their whole area, people ended up whose houses were built too low, like in the water table, people literally had to raise up their houses if they were going to be able to get flood insurance from that point forward. So there were houses that literally, they had construction companies, it's a pretty amazing thing to see, literally raise these, and when I say $1 million homes, I'm talking $1 million homes on the water, okay? Literally raise them up, put them on piers underneath the foundation of the house, put them on piers, bury in the piers, put it all up just to raise, and then have to regrade the property and dump dirt and everything to regrade the property, to raise these houses up like 4 feet so that they would be higher in the event of the next storm in order for them to get insured. It was crazy. It was crazy stuff. Yeah.
Don't they not share some people's pools too? If they
Yep.
have a diving board?
Yep. Yep.
That's another thing.
Yep. They won't insure something. Yep. Absolutely. Ben, go ahead.
So let's say an insurance company, they see that somebody played football their whole life, and they know that they're in really good shape, but they know that they got a lot of injuries from football or some other sport. Is their insurance rates gonna go up because they got so many injuries and stuff like that?
Maybe yes, if they were buying insurance on their own. But typically speaking, if you're talking about health insurance,
Yeah.
typically speaking, if they're buying health insurance, again, because we're dealing with a pool, if you're going through your, your employer for your health insurance, then typically not. Because they're not looking at you individually. They're looking at the pool. So sometimes for smaller companies, the health insurance costs are higher because the pool is a smaller pool. Okay, so the risk of loss in that smaller company is greater to the insurance company because they have fewer people to spread the risk of loss over. So for instance, a smaller company, somebody gets a cold. We're all working in the same office, we're, smaller group of people. The chances of everybody else now in that office getting that cold and all having to go to the doctor and get whatever at the same time are greater. But in a big company like our school district, not so much. So they can spread the risk of loss over more people. So the bigger the pool, typically speaking, the lower the premiums are going to be. The higher the premium, the smaller the pool, the higher the premiums are going to be. Logan, you had a question, and then Alex.
And you answered my question with loss,
Okay.
Well, I meant more if, let's say you get an insurance policy on your car, we use that example, and you kind of wanted a new car, so you total your car, and then they give you a new one and then you stop paying, like you cut the service or like you cancel your insurance?
It-
Do you have to have a fixed insurance, like for a year you have to pay, or how does that work, like, so people don't abuse the system?
Well, if you get in a car accident and you're deemed to have caused the accident, and they deem that you might have intentionally caused the accident, they can drop you, and that's fraud. You could not be insured or insurable. You know.
And like the follow-up to that is what I meant with like, let's say health insurance or something. I meant like, can people pay for like only maybe a month and then get a huge operation and then like cancel their insurance, or like do you have to
They're gonna have to
Yeah, I mean, you can be covered.
It's like
You're
part of the policy.
again, if you're going on your own and trying to get insurance, it's going to be very expensive to go and get health insurance or life insurance or disability insurance all on your own, individually. It's expensive, so it may not be worth it. If you don't have insurance through your employer, and you know you're going to have an operation, I guess you could go and. Well, they're already going to have you, I mean, if you've gone to the doctor, you think something's wrong, I guess you should wait to go to the doctor if you think something's wrong until you get the health insurance, is really what it boils down to. But if you're saying you're only going to pay the health insurance for that until you have the operation, you're running a risk. You can do that, you could possibly cancel the policy afterwards, but if you do that, again, and something, I mean, typically there's follow-up and all of that kind of stuff after you have an operation.
Oh, okay, I see. Because I just meant like if people were able to abuse the system like that, like they're on the policy for 1 month, something like really big happens, and then they just cancel the policy.
You wouldn't do that. Not if you're smart, you wouldn't do that. I mean, because you run the risk of having additional things that go wrong, yeah.
And if you recently had an operation, can't they like give you a higher rate or something like that?
Not typically. If you're if you're in an insurance pool, the rates are not based just on you alone. It's based on the pool. So typically they're not going to be able to do that. What could happen is next cycle, next time the contract is up for renewal, because that's typically how they run year to year with a health insurance policy. If there's a small enough pool and there were a few people in the pool that ended up having losses, had to go have operations or whatever, it might raise the cost for everybody in that pool in the next cycle. So not in that contract period, but in the next cycle. Yeah. Okay. Let's talk first life insurance. So life insurance is basically a contract that provides monetary compensation for losses relating to when somebody dies. The premiums are based on age, health, amount of coverage, and the type of policy that you have. And there are two broad categories of life insurance. What we call straight life insurance and term life insurance. Straight life insurance is typically more expensive. And term life is what we would call pure life insurance. Because the cost of the insurance is just basically the cost to insure somebody's life. Whereas in straight life, which we're going to talk about in a minute, there's a savings factor that's built up in the straight life insurance policy.
What was the thing you wrote?
Sorry. So it's more expensive,
Pure, it says pure.
and this is pure life insurance, right?
And for like life insurance, can you choose if anybody you want to give it to?
No. You mean to be the beneficiary? Yes. You can choose whoever you want to be the beneficiary of your life insurance policy.
Because remember I was telling you, my grandmother when she died, all of my siblings we all inherited
God bless you.
an estate, and then we also inherited like a little bit of money. On our 18th birthday, we get that money for like college or whatever that she left for us. So she didn't give anything to like my mom or my dad or anything. She gave to like all
Yeah,
of her children.
you can do that. You definitely can. Okay. So types of straight life insurance, or things about straight life insurance. So first of all, with straight life insurance, It requires that you pay premiums until the face value or the amount of the coverage of the policy is reached or the insured dies. The premiums on a straight life insurance, and part of the reason they're called straight life insurance is because the premiums remains the same over time, over the life of the policy. It therefore builds what we call a cash value that can be a form of savings. It is also called ordinary or whole life insurance. There's another type of straight life insurance that's called universal life. It's a form of straight life, but it does allow the insured, or the policyholder I should say, to change some of the terms as needed as things change in their life over time. What do I mean by that? Let's say at a certain age, let's say you get a universal life policy maybe when you're in your mid-20s, maybe before you have any children or you have a house. But then you get a house, you have some children, so you decide to increase the amount of your coverage. Well, they'll prorate and accordingly change the cost of the insurance to reflect that higher value. So those premiums will be affected by the changes. But then later in your life, maybe as you get older and your kids are maybe more on their own and independent, you decide to reduce the amount of the coverage, and so then therefore the cost will go down as well. You don't necessarily have to go out and get a whole new policy. Okay? That makes sense? It's kind of like floats, if you will. Okay? Versus the other type is what we call term life, which is issued for a particular period of time, usually 5 or 10 years. It's what we call the least expensive type of insurance. No cash value builds up, and the premiums increase at the end of each term. Because the older you get, the greater risk there is of loss as you get older. So, if we were to draw a graph as it relates to the different types of policies, one being a term life policy and one being a straight life policy. You can think of a term life policy like this. Okay? What I mean by this is this being time, so years going up.
If your money's just going to someone else.
I'll explain. It's different. It's different. Okay. So you have this extra cost in here in the early years. And then in the later years, this money helps to offset the less cost that you're paying. So now in these later years, you're actually paying less than it would really be costing you. Because later, your pure premium cost as you get older, now my costs are higher. See on this term life policy later on, my costs are higher than it would be if I got that straight life policy when I'm younger. So that's why they always say, when you get insurance, try to get a straight life policy when you're younger. Okay, because the cost is going to be less. And this savings that you're saving in here, because right now, in these early years, your cost is actually higher than your pure cost would be. And it builds up a savings that is used to offset this cost later in life. Okay? So that's why, back on that other slide, if you flip back to that other slide, flip back to the one that says straight life, it says it builds a cash value. It builds a cash value in these years that offsets the cost in those years. So in here, you have the excess cash value. And that excess cash value is used to pay that in the later years. You can also borrow against that cash value. So that cash value is actually an asset to you. Okay? I've got an insurance policy. My husband and I bought policies on each other when we were younger. And my costs now, because it built up cash and they invest it, The insurance company invests it for you. It had, for a number of years, it actually paid the whole cost of my premiums. For a number of years, I didn't have to pay any costs because my cash value was so high and the returns have been so high that I didn't have to pay insurance costs for years. Okay, so that's a nice thing. It's another reason why you would go with a whole life policy. Now, Kyle's question, as it relates to how is an insurance policy different than your will? Your will deals with all of your assets. You have an insurance, a term life or a whole life insurance policy. Really, the idea behind them is to give the beneficiaries a pool of cash. A lot of times people try to figure out, like, well, what pool of cash do I need to have? You don't want to buy extra insurance, okay? You want to buy what you need. It's just like anything else. You don't want to buy extra clothes than you need. You buy what you need, okay? And typically speaking, so people want to buy enough to bury themselves so you don't have a financial cost to your loved ones to have to bury you. I know that sounds probably a little morbid, but that's the reality of it, okay? To bury you probably costs at least $25,000 to bury somebody. Seriously, okay? And I do know this because I had to figure it out for my parents, okay? $25,000 to bury somebody, okay? And then you want to be able to pay off any mortgages or significant loans that they have as it relates to assets that they might have. So for instance, if your parents are going to leave their house to somebody, so they're going to will you all their assets, let's say, you want to have enough insurance to cover any debts or obligations associated with those assets. So now, if Kyle's parents were, God forbid, to pass, and they leave Kyle the house, his parents don't want to leave him a house with a big, huge mortgage payment on it. You know, they want to be able to leave you a house that doesn't have a mortgage payment on it. So typically speaking, they want to be able to do that. And then oftentimes, if parents have younger children, they want to leave some money so that somebody who's going to have to take care of the well-being for these children have some money to buy their clothes, pay for their food, et cetera, because you don't want to have this person, whoever you left the kids to, have to pay for it all.
So either way, someone's saving your money, like a loved one's saving your money, though, if you will, and life insurance, that's how they're similar.
Yes. Well, they're getting all of your assets. All the life insurance is doing is giving you extra cash to have. Okay? One more slide, I know. Limited payment life insurance policies are basically, you're not going to have time to finish this. We're going to stop there.